what do you think of this larger phenomenon of social media being used in certain cases by famed investors and executives? You mentioned Elon Musk and Chamath Palihapitiya on one side, but on the other end, the retail investor, the Reddit army, which Mark Andreessen over the weekend said that the internet is now the largest hedge fund in the world.
Look, I'm not an expert on I'm not an expert on Wall Street bets, so I'm speaking a little bit out of school here, but I do think that that's overblown. I mean, this is obviously relating to GameStop. And one issue is that this was telegraphed on GameStop months before. I read an analysis that's 4 months old that was actually very sharp about the technicals and how and why this could squeeze. Now, it succeeded for a while because, to be frank, Melvin Capital just was, for some reason, a deer in the headlights here. They were too big in the position and they were unaware of this. But ordinarily speaking, if I can see, if I'm in the market trading and I can see what, major market participant is going to be doing, that other participant is generally not going to succeed. So this idea that if you can crowdsource trading, it's really changing the game. No, I think that there are a few pockets where that works well for a moment, but I don't think that actually, I don't think that's a successful hedge fund then, if you will, over the long term.
So, but I think there's a larger question being asked in the hedge fund community, and even more broadly than that, about the future of short selling and whether you think that becomes a more limited option for investors to the extent that that's something they would pursue, given this new risk, this new variable in the marketplace around a quote unquote Reddit army, or the potential for social media to enable a group of people to sort of press on the other end? Or do you think that the supply and demand dynamics of GameStop were just so unique that's an idiosyncratic one-off?
Well, it's actually there's another take on it that I'd have. I mean, but look, first, future short selling. On one hand, as a short seller, there are now fewer competitors there, so trades are less crowded. So I guess that's positive. Now, they're obviously less crowded because everybody's afraid to sell short. So maybe I'm the greatest fool, but I like to think not. To me, the real issue here, and this is something that my understanding is evolving, and I only really got into this late last week and understand how I think this really relates to the broader market. But you have a situation where, what GameStop shows us is it's a microcosm of the broad market, in that technicals are generally mattering much more than fundamentals are. Now, that's a problem just on the surface, where you say, okay, well, markets are supposed to allocate capital to the best users of the capital out there, and that's a fundamental decision. So if we're not prioritizing fundamentals and we're instead prioritizing technical dynamics, the markets are not helping society. But the bigger issue really is that it's when you get down to what actually causes this. And I'm going to throw something out there that I suspect the vast majority of your listeners have not heard. But a lot of this dysfunction is being driven by the prevalence of passive investing. And I want to say one thing before questions come my way. Yes, I knew about the robo-bid, and I knew that the fundamentals are irrelevant to the robo-bid or to passive investors. But what I didn't appreciate is that as passive grows in a float, that it actually creates convex pricing behavior, and it basically becomes the driver of growth. And it is, in my mind, based on my understanding now, it's the single biggest explanation for why growth as a style has massively outperformed value. And again, it's not tied to fundamentals, it's tied to supply and demand.
Shepard Smith here. Thanks for watching CNBC on YouTube.